Hello, welcome to day 4. Today we're going to be looking at volume profile as well as the price ladder and how both of them can give you a little bit more insight than just a standard candlestick chart. So we'll be going through a few different examples and just having a look at a few strategies along those lines. So let's crack on. First up, we're going to tackle volume profile. I'll be showing you what exactly it actually tells you and also the importance of value. This is one of the main indicators on a volume profile chart, as well as some of the other smaller nuances that are very important to be looking out for. We'll then go into looking at a couple of different day types. Understanding the different day types will give you a much greater idea of the types of trades that you want to be employing on a certain day. So it gives you a good way of ordering your days and even ordering your weeks when you take it onto a longer time scale. Next up, we'll be looking at some actual trade setups. How do you actually apply it? How can you make some money from this? We're going to be looking at both continuation type trades where the market moves away from a certain area, where you see a shift in value, which again we will be talking about, and also balance type setups where the market remains in balance or reverts back to balance. And finally, we'll then be looking at price ladder. Your price ladder is where you actually see the orders from every person transacting within a market. And we're going to be looking at a few different ways of executing trades based on the price ladder. I've got a nice example of more aggressive type trade as well as more passive trade action. So we'll be looking at some of the things that I've been trading, as well as a little bit of a look into Alex's course as well. So that's going to be the completion of the ladder part of the day. And finally, just to finish off, a bit of trader development and a little quiz for you guys. This will sort of just be going through some of the things we've already touched on throughout the last 4 days. So just to keep you switched on, keep you thinking. So let's move on and start off with volume profile. What does it show? Here, what you've got is an entire day of profile. So each letter is known as a TPO, a time price opportunity. Basically, it displays every price that has been traded over a half an hour period. So if you look at the Ks, that's the first half an hour of the day. And basically the top of the Ks and the bottom of the Ks indicate the high and the low of that first half hour candle. Now it's always a half an hour period. This is a profile taken from a European session. So that's why we start on K and L. Profile began in America, so the first letters of the day are A and B, which start at 1:30 UK time. So that's why you get that slight difference and why we start on a K and an L. So that's what each letter represents, a half hour period. They layer on top of each other, and that's why you get this bell shape distribution of prices. So that's what it's showing you firstly, the distribution of prices, where the majority of trade has happened for the day. That's obviously the widest area. That's where the most half an hour periods have traded. So that's where price has been accepted quite a lot throughout the day. So let's crack on. What's all the little intricacies? First up, you've got the opening price of the day, nice and simple. You've then got your initial balance. This is the first hour of trade. Now, during the initial balance, it's often positioned to be in balance from the overnight and also just testing different prices out. Usually the initial balance is slightly thinner on trade as positions establish themselves, and then you get a bigger flow later on in the day. So the initial balance is just giving you that indication. The smaller the initial balance, the more likely that value will move away from it. We'll move on to this a little bit later. If you get a large initial balance, then people or participants have come in very early and established positions very quickly during the day. So that's what your initial balance shows you. You then have the M&N prints, which some people will also consider into initial balance because they are the start of the cash trading hours as well in Europe. So it's up to you, but generally you'll always look at the first hour on its own. Next up, you've got the volume value area. This is where 70% of volume has been traded for the day, distributed throughout the day. So it's an average where the majority 70% worked. And again, this is showing you where value's been accepted, where the majority of volume has been traded. So people are happy to trade around these prices. The market is comfortable to transact there. And you see as the market moves away, it comes back, it spends a lot of time in value. So that's why value is very important. And it's the shift of value that is key in market profile. Now, within value, it's not always within value, but quite often, or the majority of the time, you have a VPOC. This is your volume point of control. So that's the price where the most volume is being done throughout the day. And you have your point of control. That's the price where the most time has been spent. So the most different time periods have traded through that price. They're usually around about the same area, because generally if you spend more time in an area, more volume can build in that area as well. So they're key areas to watch out for. The market will often gravitate back towards them, particularly if they're very prominent. Next up, we've got a buying tail. These appear at the low where you get single prints, so just one letter creating a low, and then the market moves back into balance. What this indicates is that the market has moved lower, tested lower prices, and then found buyers, and they have pushed the market back up. Likewise, if you see a single print tail at the top, that's a selling tail, where again prices have moved higher and sellers have come into the market, pushed prices back down. So that's what the tails tell you. And also you have a close, obviously the last traded price. The close is very important in relation to where it actually closes on the day. So that's what it's showing you. They're the little elements of it that you want to be looking at. We'll now move on to why these are all important and what they really tell you about the day and what's going on. So we know all the different parts of the profile. Now we've got to move on to what it's actually really telling us. Now to do this, you need to be asking yourself 3 questions really. You need to be asking yourself what the market is doing, how good a job is it making of it, and who is in control. This is going to tell you how likely moves are to continue, to sustain the development of the move, how likely they are to reverse, and also how the market is going to trade off certain levels. So I'm going to start off by actually looking slightly backwards at who is in control. Now, I've broken this down to 3 different types of participant. That if you read different things, there's various nuances of different participant. I like to look at it as 3. First up, you have the day time frame. These are your more local prop type traders, very much like we are here. In the grand scheme of things, they're more short term. They won't often hold positions overnight. Also, their size is not something that's going to be able to influence the market. So therefore, they're a lot more reactive to levels. When there's more day time frame participants in, the market will react off smaller, very obvious levels. And that's an indication that you've got the day time frame. It's also, because of their lack of size, unlikely to actually drive the market or influence a new trend. Generally, you'll see the market reverse until you get a larger sort of initiative type move. Next up, you've got a medium term time frame. These participants do have the ability to influence smaller moves. They're going to be a lot more responsive to larger levels. So they're going to be looking at key swing highs, swing lows, that kind of thing, rather than the nuances of the edges of value throughout the day and things like that the daytime trader is more interested in. They will hold their positions for a few days. As I say, they're going to have a little bit of influence, more so a little bit of influence as they get out of trades en masse when they break over certain levels. And then finally, you have what's known as the other time frame. Other time frame players are the more institutionalized base participants, so they're going to be taking on larger positions. These are positions that can't be executed just at one price. It's something that the day time frame and the medium time frame to a degree can do. So the other time frame participants have actually got to drive the market. When you see a sustained move and then value shifting, this is usually an indication that you've got other time frame participants in the market. And until you start seeing anything change, that's where you need to be thinking, right, there is clearly a flow here. And so the market is telling you that these moves are sustained. They are likely to continue if you start seeing that type of trade. So that's what's very important about understanding the different types of participant. Now, in terms of looking at what the market is actually doing, and also how good a job it's making of it. I've done this in a video type presentation, so feel free to rewind it, stop it at any point, think through what I've said. It'll perhaps give you a chance just to get things set in your mind. So have a watch of this and we'll come back in a moment. So see you in a little bit. Going to answer those two big questions. What's the market doing? How good a job's it doing? Now, value is the key indicator on how good a job a market is doing. Has value shifted with the move in the market? And is it being sustained continually higher or lower, or is it just ranging? Now, what we've got in this example in the left, clearly we've had a bit of a trend day. The market has moved higher. This is the S&P. We've got multiple single prints just here. Now, what that indicates is that longer term participants have come into the market, initiative buying has driven the market higher. We've also seen value has shifted right up with the move as well. So this is a good sign that prices are quite happy to be accepted at these higher areas. You have got the VPOC right at the high, which can be a sense of weakness. I'll explain that in a moment. And then we continue with value higher once again, and again, and again. So this is looking like a reasonably good thing. Value is shifting higher. We actually get no overlap here as well. So clearly the market is doing a reasonable job of it. Now let me just explain this VPOC. The fact that you've got prices closing right at the very high of a day indicates that people are willing to buy at the very limit of a day. They are now long overnight. They are in need of continuation the following day. If we don't see continuation the following day, you've then got a lot of positioning towards the top of the day, which if we start coming off is going to start getting out. So be very aware of where the VPOC closes. I think a more preferable VPOC would have been around this area here. If you got that kind of thing, then it does show that value's been accepted higher, but not right at an extreme, so those positions are a little bit stronger. Nevertheless, the following day, we see a small test down in the initial balance and then balancing higher. You usually see a balanced day after an imbalanced day. The imbalance is the trend day, then you get a more balanced day the following. We then, as the arrow indicates, see value higher. Now, what is showing that this market is perhaps losing such a good job of what it's doing? Once again, you've got people very late on, the close is right at the high of the day. And this is indicating, once again, an over-enthusiasm late on, generally weaker hands driving the market higher last thing. And what we see here the next day is we do start coming back on ourselves a little bit. The trend's not over, value is still higher, so keep that in mind. Take that forward. Until value starts shifting lower, the trend is not yet over. However, this weakness caused by participants getting long a little bit too late is perhaps why we see this dip off quite early. They start on the B prints and move higher. We get a new high on the C print. So you do see an initial attempt higher, but very quickly the market falls back. So it's doing a reasonably good job. What you need to see is then where value shifts from there. In the second example, we're seeing very range-bound trade. And what ultimately what you're trying to achieve by finding out how good a job the market is doing is you're trying to actually tell yourself what kind of trades you want to be taking. Now, we've got 2 days of completely unmoved value. With that in mind, you're then thinking, right, I don't want to be looking at breakout trades. Value's not shifting at the moment. You need to see value starting to build somewhere outside of this area here. If you don't see it the following day, we get an attempt higher. We get the open a little bit higher on the day, but very quickly you start seeing the market drop straight back into value. You see it on B's and C prints, that brings us back into value. we trend right down to the other side on those C prints, and you're starting to think already, right, the market is not moving out of value, and this secondary move down late on the K print, this is an opportunity for a fade, because you know that value's not shifting on the day. VPOC has remained right bang smack in the middle of the previous day as well, so value's not changing. The market is doing a good job of maintaining value at the same prices. However, any kind of moves away from it down here are not doing a good job of shifting value. If you don't see value shifting with the move, then it's not doing a good job. More than likely to see some kind of fade opportunity and a move back up the range and back into value. So that's what value's showing you, and they're the two questions you need to answer to inform you as to what type of trades you want to be taking on for the day. Right, let's have a look at a few different day types. I'm going to go through some of the more typical things you do see, and the point of a day type is to give you an idea of the type of trades that you want to be implementing on those days. Now, if you can grasp it quite early what type of day we're going to have, then it's very easy to step away from doing trades that are not suited to that kind of day or that kind of trade that you're going to see. So let's start off with a P-shaped day. This indicates short covering. Now, what I mean by this is you don't get an initiative buying through a longer term participant actually putting on a new position or creating new value. You get it from shorter, medium term positions who then have to get out. So what happens is you see this very early shift away from the initial balance, and then the day balances out at the highs in a P shape. So it does initially look like a bit of a trend day. However, as soon as you've got that rush out, and this is the shorts getting out and buying to move the market higher, you then get this balance towards the top where the market accepts value a bit higher but doesn't continue moving value any higher. So let's move on and see how you can actually predict these, because it is doable, and that will then give you a clue very early on as to the types of trades that you want to be looking for. So what did we have a couple of days before? We had an open low and a move higher, value shifting higher up the page. Fair enough, so we've seen the shift in value higher. Stopped right on the level at 67s. That's the scale for the profile, just so there's no confusion. I know it says 62 right near that high on the profile. So it stops up at 67s. We then see the next day that the market tests lower. We get an open in value up here. We see a move lower. This is the first hour of that next day, the one with where the open is. You get this shift lower. We get a tail on the profile. So that's your buying tail. Buyers come in, buy it off the lows and push prices back higher. You also have on the candlesticks this hammer style candle, which again indicates that prices could be going higher. They do. We get a close right back at the top of the day and the VPOC near the high of the day as well. So 2 days in a row, VPOC has not shifted despite the attempt lower. So you've now got shorts in the market. The traders who push the market down here, they're not all going to get out. A lot of them who are feeling that this could be a shorter term high are not going to get out until we start seeing prices back above 67. So there you go. You've now got it in your head that there are shorts in the market. Could they all stop out? Where are they likely to stop out? Above that recent high of 67. So this tells you that on a break of 67, you want to be looking for a breakout trade. You want to be looking for momentum. You want to be looking for volume to pick up, for prices to start getting taken out and just taken straight bid. You'll see this on the ladder as it happens. And be aware that usually these types of trades happen quite early on in the day. So as soon as we get above this initial balance, which is 66 1/4, you start seeing that move higher very quickly. If you're not on it though, again, this is where understanding what type of day it's going to be, you can then start to plan your trades a little bit more around that. You know that there's probably going to be a consolidation phase at some point, and that's what we get up here. So you're then looking for places to get in, either long or short. I prefer to continue to trade it from the long side, just in case you do get any more initiative buying any higher, but also trying to gauge the top is that little bit more difficult. So that's an area I'd be looking at. These single prints, you had the Fs move higher, the Gs then came back down and created a low around 71.25. I would therefore be looking to buy any dips back towards 71s with your stop back below these single prints. So stops 69.5-ish, quite a tight risk reward, and then you're just looking for rotation back up this range, back up towards the VPOC, and then perhaps somewhere towards the high of the day as well, towards the 77, 76 area. So that's what I'd be looking for on a P-shaped day. It tells you the type of trading you want to be looking at early, and then what you want to be doing a little bit later on as well, because you know that people are going to start to get out, and they'll get out quick. So let's have a look at a trend day. This is slightly different. You see an initiative move, and then values continues to rise with the move. Obviously on a trend day higher, trend day low, you will see value continue to dip. So have we had a few clues to this? Yes, we have. We've got a large range on the DAX. This is a daily chart. So we've had, well, the best part of a month, the whole of January almost, range bound. This is late on in January, the breakout. We've had a failed attempt lower and close back in the range. So immediately when you see that, you should be thinking there's a good chance that we'll test the other side of the range and then quite possibly break it as well. This is what we got. We got the breakout, and you see value shifts higher. So that's on the first initial break up towards this high at 93. You then get the break of 93s and value shift higher once more. And then later on in the day, we get value shifting higher again. So there you have it. That's what you get on a trend day. You get multiple single prints and this continued bid in the market. So a bit like a P-shaped day, you are going to want to be looking at more breakout type trades, and you're also going to be wanting to look at trend-based trades. These are things like pullbacks. Once again, we see this pullback to single prints. This is a particularly favorite trade of mine, particularly in the DAX as well. I think it works very well, that you get this move back, the Qs make the single prints, the Rs test back. That's your opportunity to buy, and then the market moves higher once again. So look for this continued move higher. You will see a lot of flow in the market. You'll generally see volume increase as well. You do see volume pick up here. Not actually such a big day. So again, in terms of how good a job's the market doing, volume is not supporting the move higher in value. So it does add a bit of question, but you should see value shifting higher. You should be looking for single prints. And then in terms of trades, you're looking for pullbacks and continuation type trades. Next up, balance day. Now, what you get with balance day is you see a tail at both ends. You get a buying tail and a selling tail. Also, something that early on you quite often see on a balance day is a break of both sides of the initial balance. So we get it early on these M prints down here. So you get the M print break, this being the first half hour of the cash. You then get the ends, so the market turns higher, and you get the ends break out the other side. We then see rotation both directions. You get P's, Q's. Unfortunately, because of the scaling, you don't see the tail on the Q. So Q's go higher, R's go lower, S's then come back in. So you are seeing this continued just rotation up and down the range. What this tells you quite early on, particularly as you saw it on the M's and N prints, is that you do not want to be looking for breakout trades. You don't want to be looking for flags and continuation type trades. When we start getting to the high, you're looking for volume to dip off. You're looking for some kind of chart pattern that gives you a trade for a reversal. Any levels that are sort of beyond the extremes of the day become stronger levels, so give you a possible entry there. So that's how you want to look to trade these balance days. Balance days are quite common. Market, as I say, shifts from imbalanced to balanced. The majority of the time, the market is not trending in a proper trend type day. You do see a lot of balance days. So getting used to spotting them early and then changing your strategy accordingly is very important. But ultimately, that is what you're going to see on a balance day. These do require a lot of patience. Trades do not just open and then move straight to where you expect. When you are looking for these reversal trades, so say this was a level down here, you managed to get in towards these lows of the C prints, you're only really looking to back to the midpoint on these trades, maybe back to the initial balance low. You're not looking necessarily to take the trade and run it all the way back to the high. Any movement back to the midpoint, back towards the initial balance, that's where you want to be taking the profits on them. Likewise, on a balanced day, getting involved in this area, in value, is quite a dangerous game. It's very easy for the market to move higher from value, and it's very easy for the market to move lower. So staying out of there, being patient for these reversal and contrarian type trades is definitely advisable on a balanced type day. So let's move on. Slightly more interesting day, a double distribution. Now what you get on these days is you get two very prominent value areas. You can see here and here. Treat these the next day essentially as two different days. So you've basically got a VPOC on this lower day and then the obviously red VPOC up higher. So that's how you want to look to treat them. They're generally split very clearly by single prints as well. So this should act as a position that the market should hold above if we close in the top part and below if we close in the bottom part. So that's what you want to look for on a double distribution day. Clearly what has happened is we've moved higher and you were starting off to get this sort of P-shaped type day. However, clearly there's been new information or new initiative, perhaps a new position established, which has moved the market higher and pushed value with it as well. So the question the next day comes down to, can value maintain at these higher areas? Is it going to be accepted there again, or does it come back and fill in? If you get an open somewhere in the middle of the two value areas on a double distribution day, my more expected trade is you actually see the volume fill out, and we'll have a look at that in a moment on volume filling out on trades. But that would be what I'd expect after a double distribution day. In terms of trades on it, it is going to be more the information that gets you on this secondary move up into the second part of balance. But again, once you start seeing that range band, that you get this selling tail as we move higher as well. Once you start seeing that selling tail, then again you've got that single print trade, and you know that you're going to have to see a little bit of patience and watch the day rotate. On the candlestick chart, this lower distribution of value is this area here. It is essentially a small trend channel, but we are just seeing value rotate. Area of interest, top of the initial balance. We don't see any strong push inside the initial balance, and that's giving you a trade there. So any dips down to it do offer a buy and a move back higher. And as I say, if you're initially thinking this is a P-shaped day, then you are going to be looking to be getting out around those 10s, 11s, 12s area, somewhere here. Look at that P-shaped day. So that's what you got with a double distribution. Again, you're looking more for pullback type trades, range band trade. It's the information that gives you the next initiative move higher. I do this at the beginning of every week. I check my weekly profiles and mark on the very key areas for the week, notably the weekly value area high, the weekly value area low, the weekly VPOC. They're key areas that I want to be considering, and also the shape of the profile. As you can see, we've essentially got a double distribution week here on the Euro stocks. What this will do is it allows you to sort of plan your time a little bit better and plan how you think the week's going to develop. What we saw here, this is one of my old charts, hence the annotation. I annotate charts at the end of each day, just so I can have a look back and analyse how well I've done on a day, analyse things that I've been looking for. What we saw here, we got a reversal candle at the end of the previous week. This red candle here is this day here, or the beginning of the day. This is quite early on in the day. Now, what you get, as I said, with that double distribution, because we're in between these two areas of value, you expect some kind of filling out before we see too much move, and that is exactly what you get. All of a sudden, what that tells you is the beginning of the week's likely to be slow, despite the fact you've got this very clear reversal candle and you're expecting a move higher through the week. Initially, until this value or this volume and value fills out a little bit, it's unlikely that you're going to see a big move on the week straight off. So wait for that to fill out. You've got very clear opportunities for a buy as well. You've got the previous weekly VPOC, very prominent, so you expect the market to come back and test it. We get that, and because you're expecting to fill out a volume, gives you a very good opportunity to buy for a rotation higher. Ultimately, to see the trade work, you do want to get above this weekly value area. If you can get above the weekly value area high, you've then got the opportunity to move higher if you can shift value on the day above the weekly value area high as well. Key thing to note, and this is looking at volume on a composite, this area here, these 2934s, highest volume area on the composite chart. This composite looks at the volume traded over a longer period. And so once again, if you start seeing this rotation through those 2934s, back above the weekly value area high, then you can be expecting that move higher. But until then, it just gives you that idea of how you expect the week to pan out. Once again, it's also giving you a bit of a line in the sand. This is where on a candlestick chart you expect the last chance to buy the market to be at the 83s. However, you do realise, or you do notice, that the weekly value area low is 5 ticks below. So it either gives you a stop below it or an opportunity to buy the 78s as well as the 83s. So that's how I look at a weekly profile. Make sure you mark your levels down at the beginning of the week. Now, this is kind of a putting it all together, but something that I do look at as well quite a lot. One time framing. One time framing is where you get a consistent move of lower highs or higher lows. So in this example, this is the Euros dollar currency. You get a lower high, a lower high, a lower high, a lower high, a lower high. What this is showing is that the market is never testing back, but also because you're not seeing any extension, you're not seeing any real initiative lower either, it indicates that shorter term players are in control of the market. There's no real initiative, there's no attempt to really test back either. So if you think of this from a trade point of view, or as a trader, if you're short on any of this move here, any of this dip lower, you've not been put under any pressure at all. If you put your stop above the previous day's high, you have never been put under any pressure. You've been able to add each day as well. I'm talking from a slightly longer term perspective. Day traders are unlikely to hold these trades, but the shorter time frame participants are holding on to this. They're under no pressure, and what often will then happen is at the end of the one time framing, you see the move take it all back, and that's what you get on this move over here. You've also got some poor highs. What is meant by a poor high is you don't see any excess. You want to see at a high a tail. This is what you get here. that indicates a high. You see that selling comes in at the high. We're not seeing any excess on all of these days, and that is quite a bad thing. So there again, they become targets. Once the one time framing ends, which we get on this breakout, then you've got some pretty clear targets for your trade. Now, I've got marked down here, there's your clue. It's the first day on this sequence, and it doesn't always have to happen that we didn't actually get a new low as well. So there's a little bit of a clue. Also, value moves higher on this day. So you're getting some ideas that perhaps the move is over. The following day, we fill the single prints, fill out this slight dip of volume here and this dip of time spent in one area. You get that filled out, and then you get the explosive move higher as you finally get a solid break of a previous high. You get this move up, and the market closes towards the highs of the day. So that's just a look at one time frame. It's something to keep an eye out for. The difficulty is picking the turn, of course. Markets can one time frame for quite long periods of time. I've seen the bunds in particular go for about 11 days, as well as the S&P. So be aware of your market, be aware of the extent to which it can one time frame if it gets going. But do remember, that is telling you that positions are generally weaker in the market, not strong positions actually properly shifting value. Trading setups. Now, in deciding what kind of setups you want to be using throughout the day, the beginning of the day is very, very key. It is going to tell you whether you want to be considering more breakout type trades or whether you're going to be looking for more contained reversal type trades and a move back towards the middle of the range. Now, what you want to be considering is three main things at the beginning of the day. Firstly, you want to be thinking about where the market closed yesterday, one in relation to value, and two, if it closed a long way from value, how far and what conditions were with that. You then want to be looking at the open, again, in or out of value and in relation to the close. And after that, the initial balance. This is going to give you an indication of what happens early on. Is the very quick initiative, or is the market waiting for something? So let's move on, tackle the close first. Your close is very important in the sense of, if we close out of value, and this is where I feel it's more important, if you get a close out of value, what this is saying to you is that late on in the day, participants have moved the market lower or higher and have then held those positions overnight. The next day, you do need to see a continuation of that type trade. Otherwise, those positions that have moved the market late on, particularly if done on low volume, are likely to reverse as they're not seeing that initiative move that they've created continue. These are usually medium time frame participants who move the market late on, and so they do need to see that continuation. So that's where it's very important where the close is late on. Another very important thing to note on closes, they are rarely ever left untraded. So the next day we will likely trade to the close. If the market doesn't, carry that forward. You'll hear me use that phrase a few times. Carry information forward. What this does is it tells you areas that the market could eventually come back to. So if you start seeing a market trend off rapidly higher and it's leaving closes untested below, it gives you an idea that at some point we are likely to see a bit of a reversal to it. It doesn't mean to try and play shorts every day looking for that move back to the close. It could be a long, long time. However, it does just give you information to carry forward that those closes have not been tested. Now, if you get a close in value, this is telling you that the market is very comfortable with those prices and is a little bit less indicative of trade the next day. You're going to need to wait for the open and what that does. That's going to give you a better clue. So moving on to the open. Again, in or out of value. If we get an open in value, likelihood is we're going to see slower trade to start with until you see a shift of value. If we see a shift of value away from yesterday's, then a more trend type move can begin. Until you start seeing that though, throughout the day, you're unlikely to be able to play those type of trades, and a reversals type strategy is going to be more beneficial. So that's the key with opening in value. And of course, also, if you open in value until it establishes a new value, you're likely to see slower, more rotational type trades. So again, perhaps a time to step back and consider trades for a little bit later on in the day until the market has actually decided what it wants to do. However, an open out of value gives you a slightly different perspective. You've got some questions to answer. Do we open out of value and continue the move? Do we open out of value and fail to go lower and accept back into value? Or do we test value and move away from it? So they're the three things you've got to be considering. And so how it does that is very important. If you get a move, say we open low, move up to value, and then move back away, the market is showing you that it does want to go lower. It's not willing to accept value higher. It has tested it and it's found more sellers. So that's why it's showing you if we get an open lower out of value. And the same the other way, if we move lower and then can't continue, again, you're likely to get a move back towards value. Now, next up, the initial balance. This is the actual trade in that first hour. The important thing to note with the initial balance really is the size of the move. If you get a very large initial balance, this is showing that initiative has come in very early and established a range for the day. Generally, very large initial balances don't see too much further range extension because of the fact that positions have been built up very early, and then value is going to establish around where the market has moved to very quickly on the day. A large initial balance is of course going to vary with your market. For example, a large Bund initial balance is somewhere around about 25 ticks. However, a large DAX initial balance is going to be closer to 70, 80 ticks. So be very aware of that, and you'll come to establish that depending upon what markets you're trading. So that's the key with the large balance. A smaller initial balance is showing you that the market is not yet decided, and so once you get a new shift of value and new initiative come into the market, that can establish a trend. So a smaller initial balance is likely to lead more to a trend type day. So once you've got those things in your mind, you can then start considering what strategies you're actually going to use, and I'll have a little bit of a look at some of those examples in a moment. Right, you've got your trade setups and your ideas of trades that you want to be looking at throughout the day from the open, from those opening trades of the day. You then need some reference points, areas that you think the market can gravitate towards, areas that the market is likely to reject from. Now these come in the form of high volume, low volume areas, as well as your value areas themselves. So let's go and have a look at value areas first. The key thing with value area is the size of it and also its uniformity. If you have a very uniform and small value area, the market doesn't need to trade there again. Price has clearly been accepted. It's done a lot of time and a lot of volume in that area. It doesn't need to go there again. And so any moves into those smaller value areas are likely to move straight the way through them, providing very little in the way of support or resistance at each edge of the value area. So be aware of that. Small value areas generally get traded through. A larger value area is going to provide a little bit more support and resistance at the extremes, giving you more shorter term scalp type trades where you can get in, you can have a reasonably tight stop and look for a bit of a bounce from them. So that's the key thing with value areas. Also, if a value area has very little structure, and what I mean by this is it doesn't have that bell shape to it, that sort of that very curved value area. If it doesn't have that, then once again, it is likely that once you get into value, you could see congested trade where you get what is called a repair of the value area, where prices will balance out, and if you combine the 2 days, you would have generally a slightly more uniform looking value area. So always keep that in mind, the time that we could spend within value. So that's what's going to attract the market. That's what's going to slow it down as well. And that's what's important when you're in a trade. Is the market going to slow down in certain areas? Do you have to be a little bit mindful that you're going to have to wait for this trade to develop rather than expect it to just move and go straight away? Next up, high volume areas and prominent VPOCs. VPOC is the highest volume of the previous day. These are very important. If you have a very prominent VPOC on a day, so one price that is very clearly the highest volume price, that generally attracts the market back to it. So VPOCs are usually tested again. They may well become reactive, so you see a bounce from the VPOC and a move back away. Alternatively, you get the move straight through it, and like I was saying with the smaller value areas, they don't need to trade a great deal again because of the fact such volume has already traded there. So be very aware of that, but generally a very prominent VPOC, even if this is from a few days ago, so again, carry that information forward like a close that's not been traded. Prominent VPOCs generally attract prices back to them, so be very aware of that. Smaller VPOCs less so. This also works in terms of high volume nodes, HVNs, whereby you've seen over a period of days a large amount of volume traded at a certain price. Again, they attract prices back to them. Conversely to that, you have LVNs, low volume nodes, and also single prints. Single prints are where in the middle of the day you've seen an initiative move which has taken the market away from value, moved it somewhere, and then established value at a different area. These single prints are generally areas that you'll see the market reject from, particularly on the first time. And this is always key in trading. The first time is the time that matters. If you wait to see it test the single prints, test them again, and then have a go at a trade, likelihood is that it's then going to start to drift into the single prints. Once you get into single prints, the market again is likely to slow down, and because very little volume has traded there before, due to that being the initiation of a move, a lot of volume will then generally get filled out, and the market will spend some time filling volume in at that area. So be very aware of that. The first time is the time that they're important. The first time is the time you're likely to see a rejection. This goes for a low volume node as well, which you will see in one of the examples that the market comes down to a low volume node and you get the bounce from it. So watch out for that. They're the key areas that you want to be thinking about. So always have those in mind. Where's the market likely to be attracted to? Where's the market likely to be rejected from? So let's move on. We'll have a look at a few examples. I've got a few more videos just explaining, running through all of these different aspects, closes out of value, movements to high volume nodes, trend type days, single prints. We'll have a look at all of it. So here we go with a few video examples. Let's go and have a look at a few trade setups, and also we'll take in a few other concepts or things that are worth remembering and noting when looking at profiles. So first up, we have got a balance to imbalance type trade and also a move through a small value area. First thing to remember, small value areas are unlikely to hold. So what I mean by this is you're unlikely to see either extreme of value actually provide much support or resistance. You expect the market can cut straight through them. What is also interesting about this day is you've got a very prominent VPOC. Prominent VPOCs generally attract price as well. So we've got a couple of clues already that the market may well start to come off on this day. What we've had prior to this is we've had a move down. We've also then had a consolidation day, which is this profile here on the 19th, starting on this red candle and ending up here. So that's what we've had in the run up to this trade. We've seen consolidation, the market is coming off. Now we get a gap higher, you're going to get one of two things. We've got a small IB. That's telling you that there's a good potential for some type of trend for the day. We're either going to see a move back to top of value, rejection, and move higher. This I would expect to turn into more of a P-shaped day as these shorts on the 18th on the move down, get out. Or we're going to see a trend through value. As I said, because there's a lot of volume accumulated, because the value area is small, you will expect trade to move quickly through it. That's what we saw. So where is the trade? It's on momentum. When you start seeing momentum into value, when you start seeing volume picking up as we come into value, that's where you want to be looking at a short. Your stop is going to have to be inside the initial balance, and you're looking for a continuation lower, and ultimately your target is going to be that previous day's low. So you're getting a pretty decent risk reward for your trade. Additional trades to be looking for. As I said, prominent VPOCs attract price back. And what we get is the first move down actually hits the bottom of value. We then get a bounce to the prominent VPOC and also the top of single prints as well. That gives you an opportunity to sell if you've not got on the first move. If you have, it gives you an opportunity to pyramid, and still you're looking for this low. Once again, because you've got this trend type day, you get another attempt at a single print trade. You see the R's come up and make the single prints here at 70s. You then get the Z prints come up. Remember, with these single print trades, the very important thing is you take it the first time. So the Z's come up, you can get in right there. That's the Z prints. Your target, because we are on a trend type day, is going to be a new low. You do eventually get it, and it comes in down here on the break towards 35s. Something else to note as well, and this is more looking at composite volume. After those Z on that first low, and after the Z prints, the push to the low, both come in around this low volume node here. So that's always going to be a key area on these breaks. Look out for those low volume nodes. So that's what you get on the balance to imbalance. Now, what you get the next day is, once again, prominent VPOC attracts price. We've got another gap higher. Prominent VPOC attracts price. We get a test down to it, and the market turns off this VPOC. We get a move back higher, and then we start to fill in these single prints, fill the volume in. But you do, I'll get rid of some of these arrows for you. You do again get a chance to trade off the single prints. Here's the singles, and the A prints, first time they get there, offer you a good sell. You get that sell opportunity, and the market rotates back down on the Bs, back towards that 72 area, this level just down here. So again, single prints do work even the day after. Keep your eyes on them. The prominent VPOCs work as well, so watch out for prominent VPOCs. They will attract the market. Once we got through the close, we get a small squeeze, and then the market turns around again. So watch out for those prominent VPOCs, and as I say, carry forward the information that the close was not or had not yet been tested, so you expect the close to get tested. Next up, caught in the hole trade. This is a great example of a market attempting to do one thing, but doing a very bad job of it. What we've got here is we've got the Bund, and we've got the Bund attempting to fall. First up, we've got this large, strong down day, followed by an inside day here. An attempt lower on this day, which then closes much higher, hence this green candle, and then another attempt lower on this secondary red candle. So looking at that candle, you're very much thinking, yep, we've had a good go at getting lower, we've closed low as well, looking like quite a strong day to the downside. However, when you look at the profile, it's telling you something very different. Value has not shifted. If anything, value is slightly higher. The VPOC prominent is still very high on the day. and then the close dropped late on low volume. What does this tell you? The lack of volume into the close means that it is generally weaker participants that have driven the price down late on in the market, and they're closed down there. They now have got themselves caught in the hole, and what they need is continuation the next day. They need to see the market continue to come off. Initially, it does work for them. You get the open down here, so you've already got an open lower, test back up to the close, and then begin to fall. So they are getting what they want. My first trade on a day like this, when you've seen this close very low, is to buy the open with a stop below that day's low. The idea being that you at least get a run back up to the close, and that's what you would have got, giving you pretty decent risk reward on that trade. You get 70s, you get up to 83s, and you've got a risk of around about 5 ticks on that trade. So as a first trade, that's what you're looking for when we close right out of value, caught in the hole. Now, what happens after that is we get this move back up and we break on the end prints above the initial balance high, above the close and above this low. So now you're thinking, right, anyone who was holding on to those shorts and people who may well have added as the trade did work, it did push them on side, are now trapped. Any moves, any closes back above this initial balance and you're looking for a move higher. And so what is the trade? You want to be buying any close above the initial balance. You want to be buying any dips back to the initial balance, and we do get it on the S prints, on the R prints and on the Q prints, all at the same prices, around 84s, 85s. Your target, because you've got this dip of volume, is back up to the top of the single prints. Single prints and LVNs, low volume nodes, as we know, act as resistance. And so the first time we get up there, you do it on the V prints, gives you an opportunity to sell the low of the singles. You also get the Z prints to sell the high as well. And both times you do get a rotation back down the page. So there's your target if you're not, or there's a trade if you're not long, but also that's your target if you are long, based on the fact that traders are caught in the hole. They're gonna have to get out, and you do essentially get another one of these P-shaped days where the shorts are caught and they all start to get out. So that's what you're looking for on a caught in the hole trade. The only way this type of trade is going to turn over into continuation is if value can establish lower quite early on, and then the market can continue lower and continue to trend. I mentioned this trade a couple of times already, the single print continuation trade. Something that I do like to use on a trend day, on a P-shaped day as well, but trend day in particular. Now, this is on the DAX. This is that breakout day that I showed you earlier, but in a little bit more detail. This is on a 15-minute chart. Now, what we get is we do get the very strong move very early on. So you've got the indication of a trend day. You've got this breakout of single prints, breakout of the initial balance, leaving single prints. We also, as you remember, have taken out some clear levels, taken out those 93 highs there. That's what got the break on those single prints. So you're immediately thinking, right, a trend day could well be on. Where can you get in on this trade? So first set of single prints, there's your opportunity. And they come in right here at 22s. That's these lows. That gives you a great opportunity to get in, and often gives you a better opportunity than perhaps trying to play a flag type trade, just because it gives you a more certain entry, whereas a flag, you've got to play it as a breakout trade. A single print,
for a continuation, you can have it as a resting order. So you can have your bid to buy 22s. It's then a case of where you put your stop. Generally, when I look at a trade like this, I'm either going to have my stop below the fill of the single prints or 10 ticks through them. Depends on what is smaller. You don't want to really be taking this trade on looking at a stop of around about 35 ticks. It's a pretty big loss in the DAX in particular. So that's how I manage that trade. You look for a resting bid and then you're looking for continuation. The fact this is a trend day tells you that you don't necessarily want to be getting out on the break of the high. If this is looking like a P-shaped day, if you feel there's a lot of shorts that are just getting out, then having bought these 22s, I'd be looking to get out on this spike above the high. Because it isn't, you are looking for a trend. What often happens is after a break of key levels, you then get a grinding trend, which is quite a difficult thing to stay in on, or at least get in on. What you're going to be looking for is you're going to be looking for a flag break, which you do get, and then to try and stay in the trade, but it is slow burning. So just keep that in mind. You can then trail a stop on these single prints. And again, you get another opportunity on the A, B prints, which comes in around these 93 area, just up here. So same type of trade again, and then you can let it go and look for another new high or a little bit of a continuation type trade. As I say, my other target is I scale half on the way to the high of the day at the time. So it would mean you're scaling out somewhere in this area on those first 22s. But what it does is it just banks a bit of money on the trade and allows you to just then perhaps trail a stop, let it go. Once this uptrend establishes as well, you can then start adjusting the trade and perhaps have your trailing stop below the uptrend. So that's how I look at these single print continuations. If it is a trend day establishing, what it means is you don't get caught up trying to buy every little flag, every little attempt at a breakout, particularly once you start getting into the grinding trend phase of the day, which does get a little bit more difficult. So there's your single print continuation, one of my favorite trades.
Price ladder is an invaluable tool, particularly for the shorter term trader. What the price ladder does is it gives you a much greater depth of information that you don't get from a candlestick. It shows you how the market is trading around certain levels, and this gives you a much bigger clue as to whether a level is going to break or whether it's going to hold based on what kind of price action you see at the level, whether it's passive accumulation, whether it's an aggressive bid away from a level. We'll have a look at some of these examples. I'll give you a couple of examples from Alex's course. He's got a whole course on price ladder trading strategies, so goes into much more detail as to the exact ways you can use the price ladder to implement trades without even needing the use of a chart. So let's go and have a look at what it actually shows you. You've got a bids column on the left. This is your blue boxes, and a column of offers on your right. The central grey column is the price. So in this example, the blue column shows you how many contracts are bid at each price. So here we've got 83 contracts bid at 70.46. So you've got 83 contracts worth willing to be filled at that price. It doesn't necessarily mean there's 83 people. This could be one person with 80 contracts and then 3 people with 1 contract. You don't know that, and that's what the price ladder doesn't tell you. It's the way it reacts when it gets there that's key. So that's what you've got there. In terms of actually putting a trade on, you can either rest an order and wait for the market to reach it in the way that those bids are sitting there, or you can hit market, and we'll come on to that in a moment. So next up, you've got a few reference points. You've got the volume up in the top left, tells you how many contracts have been traded so far in the day. Again, this is something that you'll get used to noticing how much is expected by 8 in the morning, by 10, by 2 in the afternoon on the US Open, what constitutes to a higher or lower volume day. Again, gives you a little bit of clue as to the way trade is going to go forward. You've then got the volume at each price. This shows you very similar information to a volume profile. And also the low of the day is that little line. The shading in grey is lighter below it. So just gives you a visual representation of highs and lows of the day. So moving on to what's actually important. You have got your current position. In this case, we have got 9 lots and it's red, so it is short, and your average price of your position. This is shown by the little highlighted box in the center. This shows the average price, so it's not necessarily where you've got all 9 lots. There could have been 5 sold higher up and 4 sold lower down, which is giving you average price there. However it works, that's how you see it, and it is just basically an average of your position. You've also then got a working bid. So what we've got here is a bid to get out of the short position. If the market trades down into that bid and trades all the way through the bid, so in this instance, that top bid, which is called the best bid, so the one closest to market, that top bid has got 8 lots on it. One of them's ours. So we need 8 to trade to get that fill. It could be that we are the first lot and it only needs 1 or 2 to go down and it will get filled. You can monitor this and keep a track of where you are in the queue, so you get an idea of whether you're going to get out quite quickly or not. But that's how you can get out of a trade, either by having a bid or you can hit market. To hit market, what you would do is you would click above the best bid, and that would then take something off the best offer, so that 27 lot. So if you bought one contract at market, so at 50s, you would take that 27s down to 26, and that's how the market moves higher. All of those 27 get taken out, and then someone buys the next price as well. That's how the market moves up, and then the bids will follow it higher. So that's how the market rotates, how it moves, and it also an indication of all of your positions. Finally, that is the last trade, the box that's in the volume column, and it shows whether a trade was up or down, and also the volume of it. So in this instance, the last trade was 1 lot sold into the bid at 49.5. So that's what the last trade was. Obviously that could be a bigger number, it could be a smaller number. If the next trade again was another sell into the bid, then that box would turn white, because it's showing that more trades have gone into that bid. Again, if it trades into the offer, the box will be green and show the amount traded. So let's go and have a look at a couple of examples. I've got an example of a month-end trade. This is in the FTSE and is in fact where this ladder is from. Shows much more aggressive flow type trade. The offers come in, and you see that as the market bounces back higher, offers continue to come in until you reach a point which is a level, and you then start seeing the bids start getting stronger. So to give you a good example of the flow in the market, we'll then go and have a look at a couple from Alex's course on absorption, so more passive buying and selling in the market as well. Give you an idea of ways you can play these, and also what it is telling you about what the market is doing at that point in time. So let's go and have a look at a couple of examples. Before we get straight into the video examples, just wanted to give you a few things to, one, understand the benefits of the ladder a little bit more, and also things to consider when you're actually watching it. So first up is your ability to increase size. What the ladder shows you is as the flow comes in, you can bang your size up very quickly at areas that, if you looked on a chart, would appear to offer you no reason to add anything to your trade. But it gives you that opportunity to add very quickly, and then also take it off as well, so you can manage the size of your position, manage your risk without actually needing a chart to confirm anything. Next up, you've also got pattern plays, intra-candle if you will. So you don't actually see anything again on the chart, but these are things like flipping and spoofing, whereby a large order may be placed. This is to make people buy ahead of it. It's then pulled. The people who have got long ahead of the order all of a sudden have to get out, and you get the move back the other way. So that's the idea of flipping very briefly. If you can recognize those patterns, again, it gives you some shorter term trades. It may only be 1 tick, 2 ticks, but if you can spot a consistent pattern, there's quite a lot of money in making 1, 2 tick winners very, very rapidly. And also what it really does, big benefit here, is it adds validity to a move. You may have a level on a chart that if we break the level, you expect acceleration, you expect the market to move onwards. The ladder will tell you whether this is actually looking likely. So if you do get that acceleration of order flow, volume, that tells you you're right, and just adds to your confidence in a trade, and again gives you that opportunity to increase size on a break if that's the strategy that you're using. Next up, just want to give you a few considerations. Now think about these, keep these in mind all the way throughout this course, because we're going to see quite a few examples on the fundamental day, on the central banks day as well, where you see very good use of the ladder, particularly for increasing size and varying positions. So a few things to consider when you actually look at the ladder. First up is considering how the orders actually trade. Does an order consistently keep coming back at a level? If you see that, then what it's showing you is a sign of strength. There's clearly quite strong demand to buy at that level. So until that bid, I'm using in this example, goes, that level will still remain quite strong. So that reloading of a position shows a bit of strength in the market. Conversely, if you get orders chasing the market, this is showing a bit of desperation. People need to get filled, and they're willing to just go to any price to make sure they get their fill. This shows a bit of desperation, and also shows that the market is quite possibly being pushed beyond levels that it needs to be at, in which case, as soon as that sort of rush of orders has got filled, as soon as they've chased the market and got their fill, often you'll see the market come back as clearly it was just an order to try and execute a position. This could have been a broker needing to get out of position, could have been any sort of moves, it could have been stops as well. You see this where you see a very fast cutting through of prices. Again, this is usually a desperation type move. Stops and these type of moves generally, and that is the point, generally do reverse. So watch out for these patterns as you start watching more and more stuff on the ladder. Again, if you start seeing more trade going through a market, this is a signal that a move is beginning to build up. There's more chance of a bit of a change in the market's momentum, more change of direction, more chance of it breaking areas, breaking levels, or moving away from levels. As you see that greater desire to hit market, people are clearly realizing they're not getting filled if they're just resting their orders. And finally, if you see any absorption where you should see acceleration, this again is something to be considering. This, going back to the validity of a level point that I made in the benefits, if you're expecting acceleration and you start seeing actually an absorption where you expect prices to start moving very quickly, what this is telling you is you're not getting the type of pattern that you were expecting from the chart, and gives you the opportunity to get out of the trade before waiting for perhaps a close of a candle to come back, put you offside, and then confirm that you are wrong on the trade. Gives you that chance perhaps just to get out, or at least lighten the position if it's not showing the characteristics that you want to see for the move to continue. So with those things in mind, let's go and have a look at those examples, and also keep these ideas in mind as we go through. You'll see much more examples of this in some of the later days as well. So let's crack on.
Welcome to the absorption module price ladder analysis, where we'll be looking at the Eurobond first, then looking at the Euro stocks, and we'll be looking at two plays on the bond and two absorption plays where we really look at a very key region being the 45s, 46s and 47s, and we'll be looking at that in context with the volume and volatility that will be going through on the ladder, and how to observe various types of pattern. So what I'm going to be doing is I'm going to be playing this at 4 times the speed initially, just so we can get to the critical region that we want to analyze, and then we'll be looking as how we approach all the rest of our videos of how to really determine a high probability absorption play. So let's commence looking at this market now. Now what we'll be watching is this 45 to 47 area, and you can already see a rather anomaly area of absorption being the 46 to 45, where there's approximately 9,000 contracts that have been traded over here. And let me just bring this to your attention. So let's take a draw, and so what we're looking at is right over here, this area over here. So as you can see, there's 44, 45, 46, but namely this 45 and 46 region. So that's where we're keeping a very, very close eye on as we watched the absorptions there. Now do remember, what's very important when you are watching an absorption area is to know the general momentum and the velocity of your market, and how fast the exchange does happen at per price, and also knowing when there's an anomaly area of exchange. And when you observe that anomaly area of exchange, it temporarily puts a break in the market. And when you see that break, well, then what type of trading strategy are you going to deploy in order to effectively execute? So now let's have a look again and see how this market trades. So we've observed now that there's potentially someone that keeps on reloading the 45s. You can see it keeps on reloading here at the 45, 46, and we've just jumped up to 47s. Again, been about 9,000 contracts, and we had a false little move below the 45s just to test. We just wanted to see if the market, and you can see now the trader is putting an order right in here at 46s. Observe that once it traded through the 45s, and we put in a 530 lot there and a 600 lot, it snapped straight back above the price again. So the moment it snapped straight back above the price again, it automatically telling you that the sellers are really struggling. They really are struggling to hold the market much below. And in the beginning, we're noticing a very large amount of exchange happening at fairly rapid pace. And rapid pace being defined of how many lots are being traded, in this instance, per second. So the play that we're looking at here is an absorption play. The pattern type is a low of day iceberger. So always know at your critical areas, either your high of day or low day, what does a high amount of volume look like, or what does a low amount of volume look like? And when you see amount being exchanged of almost 10,000 contracts in this specific market, in the Bund, once it's traded from the highs to the lows of the day, and you see the market being blocked out of the 45s and 46s, well, we're looking to execute a potential trading strategy called the iceberg partner. And what you're going to be doing with the iceberg partner is you're going to be distributing your clip size. So the iceberg partner is effectively, you're going to be partnering inside with the iceberg. So you're going to be positioning yourself where you're looking at the 167, 45 and 46s and potentially the 47s, and you're going to be distributing your clip in this area. Now your risk on the trade is effectively, it shouldn't go lower than the 43s, because already we had a little peak below and the market snapped straight back above. So you're watching this area here, watching this area over here. As you see the lots being accumulated, we had 4,300 lots over here, another almost 6,000 lots over here. As the market offers into this bid over here keeps on reloading. So it disappears but then reloads, disappears and reloads. So it's either called a reloader or it's called an iceberg. And so the strategy is an iceberg partner, where you distribute your clip on the 45s, 46s, and you're scalping, between 1, 2, 3 ticks, and maybe building one little core position. So you could put in 2 lot in, another 2 lots, and then you're executing out for a couple of ticks. So just remember, That's how you want to execute this trade, where you're distributing your clip, you're scalping a few as the market blips up, and potentially holding core position for the market to trade a little bit higher. And that's how you want to be executing this trade. So let's watch how this trade is being executed. We're quite fortunate to see this trade being executed in real time once the trader has observed this absorption. He's clipping away with clips of 2 lots. So now let's have a look how this really trades out. So as you can see, he's waiting to get his fill. Got his fill. Now look here, it's gone 300 lot offered. But let's watch now as the market. You can see there's the absorption between 45s. Where the reloading happens, and it failed to follow through to the downside, just what we discussed. Now let's have a look. So it's 200 lot offered at 46s, and we want to see if the iceberg still maintains itself. Now it's just gone, there we go, it's reloaded the 46s. We've gone up now a couple of ticks on side, 3-4 ticks, might start scalping, so just scalped out at the 46s. Now you'll see that this market actually continues a little bit higher. So in the first instance, the trader just entered the absorption, scalped it for 3 ticks, but if the market comes back here again, as you can see, it's come back here again. We've got 6,000 lots now. The trader's getting a little bit more aggressive over here at the 45s. So notice it came back down, went bid back again, has bought 2 lots, actually scalped, bought 4 lots, scalped 2 out at 45s, and now it's gone on side again. So again, already there's just a lot of absorption. Now the absorption play can shift from high velocity environment where the offers are being hit quite aggressively into the bid, and the market holds up nicely. Now, when the market really starts moving away and really starts moving towards the upside, so as the market starts moving towards the upside, if the offer comes back down and the velocity of the sell orders going through the book start decreasing relative to what it was doing in the first instance when it first started trading between 45s and 46s. So what I'm saying is, when there were maybe 500 lots going through the market per 30 seconds, slows down to 500 lots per 1 minute, well, all of a sudden the sellers are slowly starting to lose they're slowly starting to lose their power and the ability to hit the bid, and I mean to absolutely hit the bid. So what you're doing in that instance, you're starting to say, well, all of a sudden this market is tiring on the sell side, and as it starts tiring on the sell side, your conviction levels on the buy side start actually increasing. So in the first instance, you observe that there's a potential reload on iceberg, so you're more scalping. But then once the seller starts slowing down, you start saying, well, potentially the buyer is going to win this battle, and in that instance the market can actually start rotating a lot higher as the sellers, for at least this round, start giving up. So we're going to start watching how this really starts trading out. So let's have a look as we continue watching this area now over here. So we've been absorbed the 46. You can see the activity has started to slow down as the buyers now start really moving upwards along the price ladder, start moving up the page, and you can see, look how obvious this is. We have almost 15,000 contracts trading at 46s and 45s. So a clear iceberg, a clear potential volume slice order, not a potential time slice order, but a volume slice and an iceberg. And so the trading strategy is you join the iceberg that you observe, or if you are short, you start exiting your position. So really very key to understand where you observe an iceberg at a high or a low of a day, and it helps you manage your position a lot more effectively. So what we're going to do now, we're shifting our observation to the Euro stocks. You can see we've just gone short here on the Euro stocks. This is going to be another pattern that we're going to be trading, an absorption pattern at the high of day in the Euro stocks. Now here is what we're looking at. So let's look. So in the Euro stocks, we're looking at an absorption at the high of day. Remember, you always know what an absorption at the high of day or the low of day is when you understand your market intrinsically well. And so, you know, in the oil market, it might be a 300 lot and a 400 lot being distributed at the high of day. In the Euro stocks, it's between 7 to 10,000 lots. So through your observations, through your journalizing, as you watch your markets day in, day out, you start getting to understand the specific personality of your market. And once you start understanding the specific personality of your market, you know what a potential strong iceberg is. And given the speed that the market is auctioning the orders, and the orders that are being traded on the book, you're able to execute a lot more confidently because you understand your market's personality. So what we're looking for here again is an iceberg partner. We're looking for an iceberg partner distribution. The market environment is high volume, moving to low auctioning activity. So what I mean by that is, firstly, there's a lot of intense volume that's going through. At that stage, you might actually wait because the VPOC has shifted, with VPOC meaning the volume point of control, where the most area of volume has been traded. So if the most area of volume been traded has moved towards the upside, and as it's moved towards the upside, if the volume velocity on the orders being traded continues in an aggressive manner, the iceberg might start giving up his position and the market could continue towards the upside. So the best way to trade this is you see the iceberg and the absorption happening, or the reloading happening on the offer side, but then all of a sudden the buy side activity starts decreasing in activity, and the auctioning starts decreasing. And the moment you notice that the auctioning speed starts decreasing, then you know that the absorber is starting to win the battle, and that's when you start actually entering your trade. So what again you want to see, first you want to observe the absorber, and once you have observed the absorber or the iceberg, you want to see the velocity exchange on the prices start decreasing, the relative rate of exchange start decreasing. And the trade, what we're looking for over here is we're looking for a scalp. You know, your risk management, 1 to 3 ticks. Your reward management is effectively looking for the low volume node here at the 82s. And as the market starts trading, you want to see how the market starts trading back towards this area over here. So let's have a look how this continues to trade. So we're looking at the 89s, and you can see, okay, we still gets re-offered at the 89s, gets re-offered, the iceberg is there, 10,000 lots being charged at the 89s, and keeps on changing. But all of a sudden what is happening, that the bids are 1 lot, 5 lot on the bid, 1 lot again, really struggling, and the offers are a little bit stronger. There is a bit of a buy here at 88s, but once he steps out the way, and if he can't lift the 89s, well, then it's going to start to say, you can see all of a sudden the bid is still trying to maintain. There we go, 700 lots have gone through, but the offer reloads again, and he puts a nice firm stomp on there of another 800 lots. 500 lots over here. Now the bid is still struggling to go towards the upside, and we're just slowly observing. What we want to see is, you see this green box here and the white box. You want to see this speed start slowing down, because the moment it starts slowing down, the auction market theory suggests that as it starts slowing down, the market will want to auction towards the other side. And as we watch over here, the market, once it starts really slowing down on the velocity, as we discussed in the previous module of market velocity, we really start seeing the market potentially moving back down towards the 82. So still watching this. The trader at the moment still holding his 89s, because he's liking what he's seeing at 89s. He's liking every time the buyer steps up towards 89, he re-offers. Now all of a sudden the 88s have disappeared. So now look here, the 88s have stepped back in, but he's not taking much of 89. 89 is still standing firm. Now we've just had to go on quickly bid over. There's still some size here. The trader is still holding on to his 89s. The risk on this trade will potentially be at the 92s. 1, 2, 3 ticks. Might be able to get a short, but again the 89s holds firm. We've now had 20,000 contracts traded at 88. We've had 13,000 contracts traded at 89, and 6,000 contracts traded at 90. I mean, a significant amount of volume trading up here, and there's going to be a pinch point. It's always the ability to collect where the pinch point, where the buyers will start feeling the pain. If this market starts trading, below 87, 86, the buyers will potentially start covering back towards this low volume node. So again, 89s and 90s keep on holding, and as you see, as this video continues, you'll slowly start seeing the velocity and volume on the ladder really starting to slow down, and as that starts slowing down, it starts suggesting that the seller is starting to win at this battle. And we're still watching 89 still holding, 88s keeps on. So it's this battle between 88s and 89s, but because the velocity is slowing down, it's starting to really for the first time now, the 88s are trying to hold the offer. You see now the 88s are coming and holding the offer. A lot more company there. 87s have been taken out now. So the 88s, 87s. Now, are we going to get a little bit more pain towards the downside? Are 86 going to be taken? I'm doing almost a horse commentary for you right here, but we can start seeing that the 86s have been taken out, the 85s have been taken out, and as the market slowly starts moving towards the 82s, and the trader actually exited 85s, but subsequently this market did start moving towards this low volume node. So that's really two key illustrations of absorption plays, one in the Euro Stoxx at the high of day, one in the Bund at the low of day. You can see at the Bund now has moved up towards the 52. So two really beautiful absorption plays, and how to scalp and trade around them, and how to potentially build a core position. And this is really important on how to position on potential volume slice orders or on iceberg partner plays.
Alright guys, what we've got here is the FTSE close. This is the month end close. So usually you expect to see quite a bit of volatility. You generally expect to see a move down as well, hence why we're already short. It's a little bit preemptive, yes. This is the last 5 minutes as well, so from 25 past until half past. Now what you're looking for is less of that passive entry and more aggressive. What you can see here is you see the offers come in very quickly, and then as the market bids back up to them, you then see the offers hold and you see the bids disappear, so you don't see any more buying into those offers as the market comes back up. So we've already moved down from 62s down to 57s, and again you start seeing those offers coming. Look at 40s, 50s, 60 lots coming in at 57s up to 59s. These all want to get filled. Now what you need to be thinking about is, if you're someone who wants to sell quite a lot, in the more passive areas where the market wasn't moving so quickly, you could sit there and just continue to reload the offer that we saw in the previous video. You saw people just slowly adding and adding and adding to the offer, and they got their fill. Now, if the market is moving a little bit more aggressively, a little bit faster, you don't necessarily want to be waiting too long. But equally, if you're selling, if you continue to just hit market and keep selling into the market and driving it down every time you sell, eventually people will cotton onto this, and you'll see a lot of the bids will disappear and people won't take your selling anymore, meaning that you'll have to sell so much lower. So the idea is, what you'll see is you see a little bit of selling, and this is why we keep seeing the market drift back up to 54s. Initially we saw the drift back up to 56, but now it's drifting back up to 54s. And as it gets back up there, you start seeing the offers come back and they hold those 40s, 50 lots again. You see that our trader's getting out of a little bit here. Market comes back up, and notice you don't see any more people hitting market. It's very small size. And again, back up to 54s, the offers start to come in once again. And that's your opportunity to sell. So we recognize a bit of a pattern here in terms of how you can enter a trade, rather than sell as the offers start coming in and as the market starts coming off. Wait for it to bounce. You see left an offer there at 51, he's actually pulled that. But you can leave an offer at those areas where the market keeps bouncing up to. So we're now looking at 51s. Keep aware of the time. So we've already had 3 candles coming down the page. So we're into the last 2 minutes now, or we're approaching the last 2 minutes. This is where generally you see the volume. Watch the bottom histogram on the chart. You see the volume start picking up. You start seeing the moves getting a little bit faster and a little bit more aggressive. So we're now coming off further, and notice every time we bounce, we're not getting even to those 51s now. When it's month end as well, even during volatile times, do keep in mind levels. You can see on the chart we've reached that previous low at 47, and once again you're seeing this quick flush up. This is where you've had quite a strong move down. There will be a lot of people trading this anyway, trying to get in, take advantage of that volatility, and you're now getting this quick bid up for those 47s. Firstly, this could be someone willing to buy that area, but also you're moving into the last minute, now seeing traders starting to exit their positions. So any liquidity that comes in now, rather than earlier on where it was getting hit and then it would start to chase the market down, any liquidity, any offers that come in are then going to get hit harder now as people try and exit their positions. And once again you see it down to 45s and we get that fast bid up, and you're not seeing those bids getting taken back out now. Again, we've just seen a rush up, and this is what you expect to see. There's this volatility, this two-way action into that final minute as positions start becoming exchanged in both directions. Once again you can see that we get to 45s and you get this quick flush up, 44s, and push up again. So clearly there's someone willing to buy it, and even these hundreds, as they chase it down, you notice that gets taken out as well. This is giving you a clue now that you perhaps don't want to be trying to hold on to anymore. Yes, we've got quite short at the bottom, a little bit aggressive, but you're not getting any pay for it. Again, that 100 lot gets taken. You can clearly see now that the market isn't likely to push any further. We're right into the last minute as well. So this is now a time to be thinking, right, can we get a reversal on? This is the expected move. We've seen the market drive down. So you're now looking for a quick reversal and a move back up the page. We've turned, you can see the candles turned. We're now past the close of the market, and then you start to get this relief rally as those shorts get out of their positions and smash the market higher. You then get 100 lot chasing up. Perhaps this is someone still trying to hold on to a position. As they chase it up, you're then looking for them to get filled and the market to come back off quite quickly, which we do see in a moment. There we go. So what we've seen here is a lot more of an aggressive type price action, something else you want to be watching out on the ladder for when you see those fast moves, those continual putting orders into the market. They take out the next price and then they keep coming in at a lower price. This is a more aggressive type of price action and something where you can be a bit faster at market.
Alright, here are the answers to the technical analysis questions. Now, I hope that you got them all right, but if there were any that you didn't, then I'll explain the answers now. Right, first up, a P-shaped day on the volume profile indicates what? Now, a P-shaped day is going to be a day where you have a very thin lower part of the volume and then value accumulating higher, creating essentially a P. Now, what this is an example of shorts covering. Shorts in the market have got out of their trade, and that's what's got that initiative move higher, and so that's why you get that thin part of the profile. But because it's not been done with there's no further buying in the market, you then just get consolidation higher up, value accumulating towards the top of the profile, hence the P shape. Market trading below VWAP is perceived as offering good value to who? The VWAP is seen as a measure of value. It's the volume weighted average price, so the average price where volume is evenly distributed either side of it. Trading below it is perceived as offering good value to buyers. If you can buy below value, then it's offering you good value. Conversely, trading above the VWAP is good value for sellers. Question 3, a hammer at the top of a range is known as a hanging man. It's exactly the same candlestick pattern as a hammer, so you will have a long tail to the downside and then a small body on the candle. However, if this is at the top of the range, it is actually a reversal signal.
Because what has happened is you've reached the top of the range, we've had some selling, buyers have come back in and driven the market back up. However, they're not managing to close the market any higher, but still closing it at the top. If you then start seeing trade back into that tail, that is going to get those buyers who bought it back up to get out of their trades, and that is why it is a reversal signal if seen at the top of a range. Right, one time framing. This indicates a stronger or weaker move and is led by longer or shorter term traders. It's indicating a weaker move and it is led by shorter term traders. Reason being, one time framing occurs when say we're one time framing higher, the market does not take out the previous day's low. Therefore, each day that anyone enters a trade, you don't have to be a particularly strong hand. If you have a stop below the previous day's low, participants do not get stopped out. Therefore, weaker hands can stay in trades. And this is often a case of shorter term traders are looking for these types of moves where you don't get put under any pressure. Longer term traders are going to wait for the market to come back off, to pull back to areas to get back in. If that's not seen, then it is just a case of weaker position traders, generally shorter term as well, which is where you see the one time framing moves, which when they reverse, often reverse quite quickly as those traders get out of the trades. Right, why do levels become weaker the more times they are tested? Reason for this is each time a level is tested, you will see more participants act at that level. So if it's a support level, each time it comes down to it, you will get more and more people accumulating positions long at that level. Therefore, as the positions are accumulated, the level becomes weaker, because if it comes back, once again, you've now got more people who could well get out of their trade, looking for a scratch, or perhaps if it ticks through the level, getting out. So the level becomes weaker because you've got more and more positions that are potentially going to get out at the level rather than hold on to the level. Question 6, these were some of the chart questions. So we've got a 15-minute euro dollar chart here. The flag breaks at 1.0996. Which level is the flag target? Those three red levels lower down. Your target is 108.33. Reason for this is the pole on the flag is from 111.43 down to 109.80, which gives you 163 ticks. If you subtract the 163 from the 109.96 break, gives you a target down at 108.33. As you can see, we didn't actually reach the target on this one, and so you would have ended up being disappointed if you were holding it right the way to target. Right, double bottom pattern on a weekly Italian BTP chart. What would confirm this pattern? As with all technical patterns, you are going to need a close, and to confirm the pattern on a double bottom, you need to see a close above the most recent swing high. If it's a double top, it's a close below the most recent swing low. So that comes in at 131.07. That's where you need to see a close higher than that level. Next question, if you're long based on this pattern, where would your target be? On a double bottom pattern, your target is the next swing high. So once you've broken the most recent one to confirm the pattern, the target is the next swing high, which is obviously at point D. And finally, based on the ATR, the gold histograms, what would you expect it to reach any of the aforementioned targets within a week? So your ATR is 1.88. The break of the double bottom pattern comes at 131.07. So if you add the 1.88 to 131.07, you get 132.95, which, as you can see, is not going to reach point D, and obviously it would not reach any of the other patterns. So the answer to that is no. It could well do it. It's not to say that it will not, but the expectation is this trade will probably take more than a week to reach its target up at point D. Question 9, market profile or volume profile question now. What prices are the last 2 days VPOCs. VPOC, your volume point of control, is the highest volume traded price. So you can see the peaks of volume on those prior 2 days, which are also marked off in pink as well, are at 160.59 and 160.58 on the first day. So there you go, 160.58, 59 are your two VPOCs. Now, hopefully you will have noticed on the first question that this is a case of shorts being caught in the hole. The market has closed below value. It has closed lower volume as well. That's those two stars which show where the close is. So you're expecting the market to reverse if shorts do not see a further move through lower prices. So where would your stop be if you were initiating a trade buying through the open? So you're buying 160.24s. Where would your stop on that trade be? The appropriate stop will be down at 160.10. Reason for this is at 160.18, shorts are still in the market. The shorts could well have not been proved right, for one thing, so they could well still reverse the trades. They could still have to get out. The market could say trade 18s, 17s, then start coming up, and you will still get those shorts caught in the hole. Whereas down at 160.10, the shorts are no longer caught in the hole. They're getting the trade that they want, and this could initiate more selling as well. So 160.10 would be the appropriate place for a stop. 159.00 possibly won't get you stopped out, but it's 125 ticks lower, so a big stop for what you're looking for as a target. And that leads on to the next question: where would an appropriate first target be? Now, your first target on any trade like this is a look back to previous value. So you look into the value area low, which comes in at 160.44. You always look for the value area low. If there are any bigger short positions that want to come in, they may well come in at that value area low and then look to get the move going again. So you're looking for a test of value. This allows you to cover a bit of the trade, and that's why it's your first target. If the market establishes inside value, then your next target, of course, would be the VPOC up at 59. Being as that is prominent, I would say that is a target that could well be on, but your first target should be 160.44. Right, the market trading below its lower Bollinger Band is viewed as oversold. It could well be trending, but it could have just pushed out. It could have gapped below the Bollinger Band as well, so it's not necessarily in a trend, but it is in an oversold position. It is more than 2 standard deviations away from the 20 period moving average, so this is deemed as oversold. And what you would then be looking for is a move back inside the Bollinger Band. That's where your trade is. With an oversold situation, it doesn't mean that there's necessarily a buy to be had. The market could stay oversold for quite long periods of time. So be very aware of that. You're waiting. Once you get back inside the Bollinger Bands, then you have a trade. And where would you expect it to trade to? If you're using Bollinger Bands, your target is going to be that middle band. You're going to see a move back to the middle band, and then it's going to be a case of, do you use the middle band as a resistance and the market continue to move lower? Then we could well be trending. Or does it then break and reach the upper band? But your first target would be the middle band. That's where you'd expect it to trade to on a move back inside. Final question. In general, high volume nodes will attract prices. The reason for this is it's been a fair price to do a lot of business at. That's why you've got high volume there. A lot of business has been transacted at those prices, and so prices are attracted back there to see if there is any more trade to be done at those prices. If there isn't, then it will either reject and move away or just trade straight through, but it does usually attract the market back to test if there are any more buyers and sellers at those prices. Okay, that is the end of the quiz. So hopefully you have now got the knowledge on some of those questions if you did get any wrong. If not, hopefully I might have added a little bit to the ones that you got right.